Let's move on to Japan. We think Japan is still particularly attractive. Many people say Japan is very highly levered. And so we put this slide in on the right-hand side, particularly. You can see that Japan's so-called net international investment position, i.e. its position as a country, net of its debt and its foreign assets. And you can see that Japan's net international investment position is very, very positive. Something like 80% of its economy is in surplus when you account for the fact that over many, many years of running current account surpluses, that money has been recycled to buy foreign assets, factories, property, bonds, all sorts of assets are on the positive side of Japan Inc. balance sheet. And its debt position is therefore much less concerning when you take that foreign asset position into account. To put things in perspective, Australia has a negative net international investment position wherein it owes more to the rest of the world than it has assets owed to it by the rest of the world. Therefore, whenever you see a nasty period of volatility in markets, the yen typically goes up because the Japanese investors repatriate the money they have overseas, driving the yen higher. The yen, as the headline says here, the yen will be a great hedge if we have some sort of a traffic accident, which is possible. And so if you look at the left-hand side, the black line, you can see how much the Japanese yen is undervalued using what's called PPP or purchasing power parity. We don't see any reason for the Japanese yen to go anywhere but, generally speaking, higher, particularly during periods of volatility. So it represents a very significant anchor to windward in the portfolio. And our Japanese equities that we own are all unhedged, which has been quite a considerable benefit as the Australian dollar has weakened. Japan's revenues per share are going up. The next few slides I'm going to show you compare Japan with the USA, and people are paying a lot more for US earnings than they are for Japanese earnings. These are Japanese revenues per share. They are to some extent benefiting from Japanese companies buying back their shares. Japanese corporate balance sheets are extremely lazy. They have too much cash on hand. Japanese companies are increasingly buying their shares back, which makes sense. But the revenues per share are going up quite nicely. If you were to look at the USA versus the rest of the world, the USA is blue. Those revenues per share are also going up. And compared to the rest of the world, it looks like the USA, of course, is a place where you want to put your money because revenue drives earnings, revenue buys you market share. But what I'll show you next is that gap does not come from a Japanese problem. It comes mostly from a European problem. This is the revenue per share for the USA versus the revenue per share for Japan. And you can see that the Japanese number is as strong and getting stronger than the US number. And so if you're going to be investing in markets with revenue mattering, which it does, then you really, really, really want to buy into a market that's much cheaper for the same revenue growth. And you can see that the Japanese forward PE here is only at about 14, 15 times. It's the red line. And that hasn't really budged for a while, even though the Japanese revenue per share has been growing and the Japanese earnings per share are consequently growing as well. So we think Japan is still quite badly analyzed. We think Japan still represents a very significant opportunity. And in a world that appears to be polarizing, where the EU is going one way, which is anti-Trump, it's quite likely that Japan and the USA get closer together. And we think there's going to be quite a significant advantage, investor advantage from looking at Japanese companies with respect to tie-ups with US companies and the needs of the US economy for capital investment, in which the Japanese excel.